Welcome to Real Estate Secrets Unlocked, the podcast that takes you inside the minds of the industry's top professionals, revealing their top secrets to success. I'm your host, Danielle Damianov. Whether you're a seasoned pro or just starting out, get ready to learn the latest trends, strategies, and secrets that will help you succeed. Join us as we go beyond the basics and explore what it takes to make it in the world of real estate. So buckle up and get ready for a wild ride. This is Real Estate Secrets Unlocked. Hey everybody, it's Danielle Damianov, and I am here today with Ascencion Guzman. I love saying that name. He goes by Ace for short, and he is here to talk to us about tax strategies, which I thought is the perfect timing since we are right in tax season. And just kind of want to talk about a lot of the people that listen to this podcast are real estate agents or mortgage brokers or in sales. And there are a lot of retail mortgage brokers that work for like a bank or Movement Mortgage, Countrywide, things like that. Not Countrywide, Cross Country. Countrywide went out a long time ago. And those types of people, which is what I was, a retail lender, are W-2. And you really can't write anything off. So even if you take a real estate agent to lunch or you go and do an event or whatever, you can't write anything off when you're W-2. Switching over to the broker world, I'm now a 1099, which I'm so excited about because I have legitimate business expenses that I can legitimately write off now. So want to talk about kind of, what are some of the things that you can write off? And then also the differences between an LLC and S-Corp and stuff like that. So why don't we start with that in terms of the different types of structures? So whether it's an LLC, an S-Corp, if someone is 1099 as a real estate agent or a loan officer or a sales professional, for example, they're going to be filing a Schedule C because the lender, the bank, the mortgage company, the real estate company, they cannot pay another company. So with a Schedule C, let's, I guess, talk about some of the write-offs. And then I do have a question for you. I know a lot of real estate agents will become a PA. And so I'm wondering why they would do that and what the benefit of that would be.
Okay, so yeah, first and foremost, let's go ahead and talk a little bit on what a independent contractor or a self-employed individual necessarily is, or what they start off as, right? Normally, what I see individuals starting off as, and I started off there as well too when I ended up opening up my business, was a DBA. Now you could call it sole proprietor, you could call it DBA, fictitious name, you could call it independent contractor, self-employed, whatever the case may be. However, without going in or opening up an LLC or establishing an LLC first, right? That is normally the first route that gets done. And what is a sole proprietor? Well, it's essentially like a self-proclamation. It's essentially stating, hey, I am a business owner. I own a business. I have a service. I have a product or whatever the case may be, and I'm offering it to the marketplace, or I'm selling it to individuals, and people are coming for my services. So it's a self-proclamation saying that I am a business owner, whatever the case may be. Now, as a sole prop, right, you can essentially utilize your own social security as the business's EIN. So you and the business are technically one. Now, your social and then the business EIN essentially can be one and the same. Now, if you want to get a separate EIN for your sole prop, you can. However, you can only do that once. And if you want to do that again for another DBA, then it becomes essentially a step-by-step process to establish, because the IRS will recognize the EIN for a sole prop. It won't give you a hassle for getting it first, for getting just one for the first time. But if you try getting a second one for a separate DBA, for a second sole proprietor, whatever the case may be, there is this different process because the IRS already recognized you with a separate EIN for a separate sole prop. Now, that's essentially what it is. Now, An LLC. And do keep in mind, none of this is financial advice. I am no way, shape, or form a lawyer and attorney that can be giving this type of advice. However, I've been in the industry for about 6 years, so I know a thing or two on how, these different type of entities and entity structures work. So yes, sole proprietor is 1040 Schedule C. LLC, single member, is also the same thing, 1040 Schedule C. Now you can have multi-member LLC, which is a partnership, 1065 that comes into play. However, if you got an LLC, what is the difference between a sole prop and an LLC? Well, it essentially um, separates, and it essentially separates the assets, right, between personal and business. So a lot of people, what I've seen or what I've heard, and then what the questions that I get when people go in and say, "Hey, well, if I open up an LLC, does that open me up to more write-offs?" Essentially, the answer to this question, I would say no, because it's still the same as your 1040 Schedule C. Tax return still the same 1040 Schedule C as a single member LLC, right? However, the only difference is the entity structure, right? It's essentially just a separation of personal and business assets. So that means that if something were to happen, let's say, for instance, whatever industry that you're in, whatever line of business that you're in, if there is a risk tolerance and essentially you get sued again, this is just, you know, my opinion, just things that I've learned and, heard. If for whatever reason you get sued on your personal side of things or your business side of things, they can no longer come after your personal assets. And if you get sued from the business side of things, I'm sorry, from the personal side of things, they can't come after your business assets, right? It's a separation of that, right? It's just that asset protection that you get. However, when you do establish an LLC, you got to be maintaining that corporate veil, is what they call protection of the corporate veil. You don't want any piercing of the corporate veil, and that just means recording your minutes, having board member meetings or board of directors, if I'm not mistaken. I think it's board members. Board of directors is one of the same. However, one of them is for S-Corps and the other one is for LLCs. And you want to have these meetings, right? Essentially, at least like once a year, an annual meeting. There is other strategies that could come along with it. It doesn't have to just be any random people. Call us, would be your family members, husband and wife, children, whatever the case may be. Now, essentially, those meetings are what gonna or and this is again just what I've heard. I haven't seen it happen in real life, but things that I've heard, stories that I've heard from mentors of mine that have, been there, done that with the LLC structures and helping clients develop these entities. Right, these minutes are the ones that essentially give that protection of that corporate veil. So that way, there ever is a lawsuit, they see these meetings being recorded. They're saying, okay, well, your LLC has been operating as it should be, so we can't go after your personal assets. But let's say that is not operating the way it should be, then it's called piercing the corporate veil. So they're gonna be like, well, you haven't been operating your LLC as it should be. Now we could come after your personal assets, right? So that's essentially one of the things I would say. Be careful when you go out and open up an LLC. Make sure you're talking to an attorney, someone who can essentially guide you the proper way when it comes down to establishing this type of entity. Now, when it comes down to an LLC, you can also do what's called an S-Corp, right? Um, you could essentially file a 2553, and that's essentially the reclassification of being taxed as a S-Corp, right? You're telling the IRS, hey, I want my LLC to be taxed as an S-Corp. Then you end up getting a letter in the mail, seeing it happen, right? I've already helped numerous clients with this strategy, and it is a strategy, right? Now, why would you go and open up an S corp? Well, when you open up an S corp, you no longer need to pay self-employment taxes, right?
Hey, real quick, if you're enjoying this podcast, make sure to subscribe to my YouTube channel, Real Estate Secrets Unlock, and hit that notification bell so you never miss a new episode. And by the way, if you're a mortgage or real estate professional looking to level up your business, check out the Done by One CRM. It's at donebyone.ai. It has tons of tools that will help you automate your business, automate your systems, your lead generation, your lead follow up, social media, email marketing, and it will allow you to close deals faster. If you are ready to take your career to the next level, join my team. We are looking for real estate agents, mortgage professionals, and real estate agents that want to be mortgage professionals. We're all about support, growth, and crushing it together. The links are in the description. Check them out now and let's grow together.
The essentially the bad thing about sole proprietorship and single member LLC, even multi-member LLCs have to pay self-employment taxes because it goes into a 1065. The 1065 doesn't pay any taxes, right? Because it's a pass-through entity, but those profits pass through to the partners, and then the partners have to recognize that's K1 on their 1040 and then pay self-employment taxes on that, right? Now, same thing goes for the 1120S. However, there is no self-employment tax that gets put on the return, right? Um, that's essentially why you would want to go that route. Rule of thumb is if you're making over, maybe anywhere between $50,000, $60,000, $80,000 or more in profit, net profit. This means bottom line, not top line. Bottom line is essentially what you're retaining, what you're bringing home, essentially what you're recognizing as profits for the business. If that is the case, then you are going to want to consider opening up an S-Corp. Now, when you open up an S-Corp, you're going to get this letter in the mail. IRS is going to send it to you. They're going to essentially state that one of the that you have to put the shareholder or one of the shareholders, whatever the case may be, and forgive me for kind of chopping it up here, but essentially what they say is in the letter, it basically states that you have to put someone on a reasonable compensation, right? And that's really what, so essentially the only self-employment tax that you're going to be paying.
So you basically have to pay a W-2. Like you have to pay, even if you're a sole, like let's say you're the only owner of the company and it's an LLC and you say, you know what, I'm making too much. I want to turn this into an S Corp. Then you have to pay yourself basically your salary. What,
W-2.
yeah. What is reasonable?
Mm, Well, there's different structures or different ways, rule of thumbs that you can go at it. Normally, what the IRS would consider reasonable is essentially whatever position that you give yourself, whatever title that you have in the business. Essentially, what is the average salary for that title or that position that you are in the business? There is also a different rule of thumb that you can go by. Is at least 60% of your profit, anywhere between about 40 to 60%. At least that's what I've heard, mentors say as well too, of whatever your net profit is, recognize that as reasonable comp. Obviously, you don't want to go any lower than that. You don't want to just go and say, well, I'm going to give myself a W-2 for $10,000 or $12,000. Right? It's just like, okay, well, that the IRS will see that as tax evasion, right? Um, but essentially that W-2 does eat, or does take the hit of self-employment tax. It's technically the 15.3% is still there, right? And that's the Social Security and Medicare, and then Social Security and Medicare that the business also has to cover, which is essentially going to total up to the 15.3% that you're still seeing, come out of the reasonable comp or essentially the W-2 salary. But yeah, to answer your question, going back on what is considered reasonable comp, to the IRS's eyes, reasonable comp is essentially whatever position that you give yourself in the business, what is the average salary that that position takes home?
Okay.
Yeah.
And you can pay multiple people. Like I know some people that pay, their kids. What is I think the max you can pay your kids is what, 12.5?
Hmm. Standard deduction, whatever the standard deduction is for the year. So, yeah, there was like I think 2023, maybe 2022 was 12,500. But this year, I mean, you're seeing it maybe like at 14,000. So actually, if standard deduction goes up, then that's the limitation that we would essentially advise clients for hiring their children at. Now, why would we recommend the standard deduction? Because, well, they don't have to do a tax return, right? If it's less than the standard deduction, there is still some rules that come into play. Now, you wouldn't want to hire your children under your S Corp. You want to hire your children under a sole prop or a DBA. That's where you would want to do it. But if you're already an S Corp, there is a strategy to, by all means, utilize, right? If you're going to go that route. Now, why do I say you don't want to pay into the S Corp? Because if you do pay into the S Corp, you're going to have to pay FICA taxes on that money that you're giving them. Now, if you don't, right, if you go straight through the DBA or through a sole prop, 1040 Schedule C, there is a strategy called the family management. You can open up what's called a family management LLC and essentially pay your kids through there, give them a salary through there, and essentially, pay the family member LLC whatever the amount is that you're going to be paying the kids, zero out basically, right? Because it's the income, and then whatever the kids are getting paid kind of zeroes out. But then you're avoiding FICA taxes legally, right? By law, you can essentially not pay any FICA taxes if that is being paid out under a DBA. Now, there might be different limitations for states, so it varies state by state. So you might want to just look at the rules of whatever state that you're in on that, for this strategy. However, um, right, if you're going to be hiring your children, you wouldn't want to do it under S-Corp. That's just really the thing, because then you wouldn't get the full benefits of the strategy when it comes down to utilizing, having to pay FICA taxes and whatnot.
Right. So then maybe you have a separate, LLC that you have you have your company and then you have a marketing agency that is your LLC that your kids work for and stuff like that. And then you have an S Corp for your main business.
Yeah, correct. And then the S-Corp can essentially just 1099 the family management LLC. Family management LLC recognizes those gross incomes or that gross income, and then just writes off whatever they paid the kiddos. Yeah.
Right. Okay. And so then the kids don't have to pay taxes up to 14,000.
For 2024, correct.
Okay. And so what are some other so one of the things and I actually I own a CRM company for real estate mortgage professionals, and we're having a big issue right now with the A2P 10 DLC registration for texting. And so anybody that wants to send like mass text messages and stuff like that has to have both. Now they have to have an EIN number, which before they did not. And so I always thought that in order to get an EIN number, you had to be an LLC or some sort of entity, but apparently you don't. You can go straight to the IRS website and get an EIN. So let's just say somebody like they're a sole proprietor, they're 1099, they work as a mortgage broker or a real estate agent, and they want to get an EIN number. Do they have to have a name, like a business name for that EIN, or could it just be Danielle Damianov and then my EIN number is under my name?
I've seen that. I've seen clients do that where they do, and essentially they'll go that route where they'll go to the IRS website, IRS EIN, which is for free, by the way,
Yeah.
if you guys want to utilize that website to your fullest extent. Um, you go on there, you can utilize just a EIN with your own name. You can. I've seen it. I've seen SS4 forms that way. Um, yeah, you can go that way. And what does that do? It masks your social, right? In a sense of why people would go that route. In a sense, as aside from the strategy that you were utilizing as well too, because you want to get the EIN so you could do those mass text messages, which is something that you can auto utilize it for. But what I also see individuals utilize it for is because, well, they want to mask their social whenever they're making 1099s or whenever they're doing a W-2 or whatever the case may be for their employees or for their contractors themselves. They don't want to get that 1099 and then put their social on there, because now then their social is exposed, right, to their employee or to their contractors. So then they'll just mask that with their EIN that they get from the SS4. That's what I've seen people do.
Okay. And so they're still, even with the EIN number, though, they're still filing just the same Schedule C. And I want to talk about some of the write-offs because, as I
Yeah.
mentioned in the beginning, there's a lot of not real estate mortgage brokers out there that work for companies where they're still W-2 and they're still paying, for their own marketing, their own this, their own that, and they cannot write it off. So once you become a 1099, you have the benefit of writing off your advertising, writing off your marketing, writing off your CRM, writing off travel if you're traveling for business, writing off your meals, and entertainment if you're doing that for work. So you have so many more benefits in write-offs as a 1099. What are some of the write-offs that, the most common write-offs and maybe some that we don't see that much, but are things that we can write off?
So the most common ones, I mean that essentially people don't really utilize to their fullest extent is usually the home office. That's what I've seen. There's two methods of going at that. You can actually do the actual method, or essentially the percentage method. I forget the form on the top of my head. There's so many forms out there, but it's essentially you the percentage or the square footage that your home is, that's the essentially the percentage that you get to deduct or write off of your utilities, right? So your internet, your phone, your light bill, your water bill, things like this and that nature, right? However, um, if you kind of overdo it, I've heard stories. I haven't seen it happen on my end, but again, I've heard stories where, people kind of do overdo it, and then there's a red flag that gets triggered and the IRS wants to audit you. If you utilize that method. So I would say if you're going to utilize that method, stay anywhere between the 15, maybe 20% range of writing off your utilities on that form. That's a good rule of thumb to follow. However, there's also the simplified method, which is safer, and that's essentially writing off up to 300 square feet of your home office, and that gives you, I think it's $5 per square foot, so $1,500 up to $1,500 that you get to write off on your home if you utilize the simplified method. And all that is just, you get the total square footage of your home, and then the square footage of your office, and then it calculates, whatever the square footage is for your office, multiply that by $5, and then that becomes your write off or
Okay.
a tax return. That's the one I don't see a lot of people taking advantage of, and that's the one I usually will, you know, um, ask my clients for if they have a home office. But for realtors and loan officers, I mean, I don't know if there's any driving involved, but I would assume there is. There is a lot of driving, right? Which would be auto, right? That's another good one right there, and a lot of people ask that one too. Now this is the one that I see a lot of people utilize. Not a lot of people overlook this one because, well, it's a very common one. Now, where is the rule, right? What is the rule with mileage and auto actual? Well, that's essentially, either or. So people want to claim the mileage, but then they go, well, what about the gas? Well, it's either or. You can either do gas, oil, repairs and maintenance, car washes, insurance, um, anything of that nature, right? To maintain the vehicle, that's called auto actual. And there's a special worksheet that you can fill out on the Schedule C, 1040 Schedule C that goes along with it. Or you can just go straight to utilizing mileage, right? Now, if you're going to utilize mileage, make sure you're utilizing, a app that's going to help you, track your miles for when you're actually going out there driving, um, essentially utilizing your vehicle for business purposes. Now, the IRS essentially states, and normally the other question that I also get to for the vehicle is, well, does it have to be under my business name? Does it have to be under my LLC? Do I have to get wrapping on it? Do I have to get an advertising? I mean, you can, if that's what you want to have on it, right? If you want to just advertise, because you are going to be in a lot of front of eyes, right? You're going to be driving around a lot of people, and you want people to see your vehicle. You want them, advertise on that. But do you need to have that to write off certain expenditures for your vehicle? Not necessarily. Really, what the IRS cares, even if it's for an S-Corp, an LLC, whatever the case may be, as long as it's utilized 50% or more in business, you will be fine. Um, any other expenses? Advertising, like you said, is a good one. Um,
So going back to the car real quick, in regards to and what I've heard about with the cars is like a lease. So if you have leased, you
yes,
can write off your lease payment. If you own the car, you can't write off the payment.
nope, exactly. Very true. So, if you lease a vehicle, those lease payments are a write-off, tax deductible, right? It's essentially you're renting out equipment, you're renting out a vehicle. That's what it is. And if you are essentially paying off a loan, right? Or you're paying off the bank for your vehicle, no, those don't count as write-offs. The interest counts as it. You can write off the interest that you pay on that vehicle, but you can't write off the car payments. Now, why can't you? Well, because in accounting, right, that's essentially a deduction of a liability. So essentially, that doesn't go into the profit and loss, right? What goes into the profit and loss? Well, the write-offs for the lease. That's essentially where it comes in, right? That's why you can't really go that route, because that's just the rule, right?
Now, you don't need the lease in a LLC. You can have the lease in your own personal name.
Correct, as long as it's 50% or more in business, 100%.
Okay. Awesome. So, another perk that I want to kind of bring up that has nothing to do with write-offs, but in talking about some of the reasons why you would want to get an LLC, and let's just say you're a mortgage broker or you're a realtor, and obviously your company that you work for cannot pay an LLC; they have to pay you individually. So in that case, you're going to be a sole proprietor, Schedule C, or you can do a DBA with an EIN. Like you had mentioned. However, that doesn't stop you from opening up another LLC that, you can utilize to take advantage of some of the other tax, benefits as well. And one of the other perks that you can get is basically getting business credit in the business name. So, for example, I have the Amex Platinum Card. I have it personal and I also have it for business. My Amex Platinum Business Card is not on my personal credit. So that, I mean, obviously, if I'm late or whatever, it's going to hit my personal credit, but it's not going to affect my debt to income ratio if I'm going to apply for a loan or things like that. And there's tons of perks with those business credit cards or getting business financing or business lines of credit and stuff like that. Do you know anything about establishing business credit that you could share? And if not, that's fine.
Well, be honest, I've never I mean, I've heard of DUNS numbers.
Right.
I've heard clients asking questions on that, but never really got my feet wet really for that. I
I'm
mean,
gonna look into it.
maybe that should be the next thing I should look into, but to answer your question, I mean, the thing that I know on the top of my head, and this is just me, top of my head here, a business credit is just a two-digit number compared to, like, your personal credit, at least from what I've heard. And that's really just all I know, and it's a DUNS number that you're gonna wanna look for. So Duns& and Bradstreet, that's what the essentially the credit bureau, if I'm not mistaken, for the business,
Right.
that's what it is. But, I mean, if there's any strategies for that, I don't really know, and I apologize.
No, no, that's okay. Yeah, no, but that's a definite perk of having the LLC or having a business name is being able to get business credit and get business lines of credit to help you run your business, and it's not actually going to affect you personally. I mean, I was talking to a guy recently who was trying to get a mortgage, and he was basically like, the debt to income ratio was too high. So the strategy that we're using is open up business lines of credit, move all of the personal credit over to the business lines, which is going to free up his debt to income so he can actually buy what he wants to buy. So that's another thing, especially if you're running like a bigger business. So before we go, let's talk about some apps or tracking tools or different things that you think would be helpful for people. I know that there's a mileage app. I can't remember what it was in terms of and one thing I do want to kind of point out and mention is if anybody is that's listening it hires a virtual assistant overseas. I have the form for you. It's a W8 Ben, I believe, that you would have them fill out. And that way, when you're paying them through Wise and stuff like that, because I made the mistake of paying people like PayPal or like that Venmo, Zelle, that type of stuff. And I wasn't really tracking it as a business expense, but it was. So if you have
Mm.
virtual assistants, you're going to want to have them, fill out that W8 Ben form and then pay them through something like Wise or Zoom. It's XOOM is another way you can pay them, pay the Philippines very easily, very quickly from your cell phone. Um, but that way, you're kind of staying legit in with the IRS. But in terms of, is there any like apps for tracking or like something that you would recommend, an Excel spreadsheet, because what I find is when it comes tax season, I charge everything on my credit cards because I have a record, but then I'm printing out a million pages of statements for the past year. And so this year I'm doing quarterly. I am not doing it like that anymore. And I'm literally highlighting marketing, advertising, this, that. It's so annoying. So I need a better way. Ascencion. Tell me how to do it better.
One of the ways to go with that, you could go straight directly getting a bookkeeper, getting an accountant to help you with those deductions, or get QBO, learn the system, learn the process. Or you could just go straight and opening up a spreadsheet like you were talking about. Just go on Chat GBT, dude. Just, hey, create me a spreadsheet for me to keep track of my expenses for this type of business, whatever the case may be. And then it would just create you a basic spreadsheet, right? You can also do that. Um, Now, to keep track of mileage, I have a client that utilizes Milo IQ. Milo IQ is very good, at least from what I've seen, it has been good. Everlance is the one I use. And then QuickBooks Self-Employed is another one I see people use. But to answer your question, to go back on essentially, your question was how to keep track of your expenses, your income and expenses, right? Um, it's just a matter of just keeping track on that. I would recommend on a monthly basis, at least, or weekly, and then monthly, because that's what we do for our clients. For our clients, what we do, because essentially where I started off at is bookkeeping, right? And then from bookkeeping, I went to tax prep, and then from tax prep, I went to strategy, and then essentially, though, what we do for our clients is we do daily bookkeeping, right? It's every day. We're just posting, downloading transactions, categorizing the transactions, posting them into the financial statements, and then we're just keeping track of that on a daily basis. And then we go to the weekly, where it's essentially, hey, my team, right? Because I have a team that manages this. Where we at with this client? Blah 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 blah. We got a Trello that essentially shows the where we're at with all our clients. We're pending any statements. We're pending any reconciliations. And then towards the end of the month, then we're there downloading the bank statements. Credit card statements usually end at a different date than the end of the month. You have some credit card statements ending at, mid-month, whatever the case may be. Um, and then we're just getting those statements, putting them on there for the team, or essentially just reconciling those as we go. And then what I do for my clients is I meet with them. Either we have two ways of going at it. So it's either the quarterly, and I'm just saying this because of what I do, the route that I go. Advice that I would recommend is, yes, you would want to meet with your accountant or your bookkeeper at least on a quarterly basis, because what that does is it gives you a good bird eye view of what's happening with your business. And then it allows you to also, make better choices with your money, right? It gives you that financial clarity that you need.
Right.
And I've realized that people without that, they're just, b- the blind leading the blind at the end of the day. That's really what it is, right? However, um, when it comes down to utilizing your resources or your bookkeeper to its fullest extent, you just want to make sure that you have someone that you're meeting at least on a quarterly basis. So there's the quarterly, and then there's the monthly. You could also do monthly. I've had people want to do weekly. Right now, I actually have someone that wants to do weekly meetings, where I'm like, okay, I could do weekly, but I'm giving you some time to hire somebody on the team, because I'm gonna have to get somebody straight directly for that, that one
Yeah.
client,
Are
because
you
that
only
yeah.
licensed? Do you do bookkeeping? Where do you do it? Is it everywhere? Is it only in Texas? You're in Texas.
I do well nationally. Yes, we do nationally, because I'm not gonna lie, we do have clients outside of the state of Texas. So yeah, we're national, man. We're national. Bookkeeping is bookkeeping is bookkeeping. Um, However, where does that come into play? I got 6 years worth of experience. No, a lot of people say, well, do you have to be a CPA to do that? No, you don't. You just got to be working with someone that knows their stuff. Essentially, um, just because, and this is not to dog down anybody, to talk down on anybody, but I have heard horror stories of people who even have their CPA license and just don't know what they're doing. I mean, just because somebody has a license doesn't necessarily mean that they're qualified or more qualified than somebody without.
That's any
And that's
profession.
it's any profession, right? That's the truth. It's the truth. But at the end of the day, what makes me qualified or what makes somebody without a license qualified is a track record, hard work, grit, resilience, and essentially somebody who is keeping track in your stuff. And
Yeah.
yeah, that's just really what I would recommend that you look for. Yeah.
Absolutely. Well, thank you so much. I really appreciate you being on. This is all great stuff for people to kind of start to think about how, they want to structure their business, whether it's for 2024 taxes or moving forward for 2025. And obviously, as your business grows, your structure grows also. So, a couple of great tips to look into is what you can legally write off as, a 1099, some of the different tax structures, getting your EIN number, looking into getting some business credit. And then also, really looking if you do have kids and wanting to legally be able to pay them. That's another big thing also. And if anybody's looking for a bookkeeper, Ascension's information will be in this down below in the comments so we can make sure that they can reach out to you and they have all of your stuff. So thank you so much. I really appreciate you being on.
Yes, ma'am. Thank you so much for having me on, and take care.
Yep. Bye, guys. Well, that's a wrap. I hope you enjoyed today's episode of Real Estate Secrets Unlocked. Don't forget to subscribe to our show on your favorite platform, and we would love your feedback. Check us out on social and let me know what topics you want more of. Don't forget to like and subscribe to our channel and our show. I'm your host, Danielle Damianov, and until next time, stay motivated, stay excited, and keep growing in this crazy world of real estate. Thanks for listening to Real Estate Secrets Unlocked.